Well, hello, everybody. Welcome back to another week, another interesting and crazy world we live in. Developments in the past week, some days have looked, encouraging, and then we get all kinds of bad news. And I guess such is the world we live in today, where the level of uncertainty is pretty high. But one thing you can count on is us to have really good content and ideas for investors. Replay of these webinars weekly, my weekly what's on my radar that we do, all our ETF 101 series and so forth. So if you're not already following me on YouTube, check it out and check those alerts so you know when we have new content up. Again, a big thanks to all that support the effort of me here on Berman's call, all the companies behind us here, and most importantly to our key sponsor that's been our partner, delivering education to Canada for 8 years strong now. And really can't say enough about our partnership with BMO. So thank you so much. And again, for those of you who have already made donations, thank you very much. These webinars and educational events are all free of charge. And if you're getting something from them, all we ask is that you make a donation to one of these charities, Cancer Research at Sick Kids Hospital and Dementia and Alzheimer's Research at the Baycrest Hospital. Both world-class institutions that any Canadian should be very proud to support. Myself and my company are thrilled to match your individual donations. So when you get the email that comes out after, there's a link on it. Click the link, make the donation there. That way we can track them and match them and double up on your generosity. So our guest tonight, my good friend, longtime Kev, it's been close to 25 years that we first came across each other in the investment industry. Kevin is a leader in the ETF education space. He's the managing director of BMO Etf. So he oversees everything at BMO ETFs related to the sales and the distribution and the educational effort. And he's here tonight during tax season to tell us what we can expect. Kev, over to you.
Thanks, Larry. Always great to be part of these sessions and always great to join you and focus in on education. And you're exactly right. Given the time of the year it is, let's talk about what to expect during tax season because, of course, ETFs have some interesting things to think about, and we're going to talk to you about that. Now, always want to start off with a little bit of disclaimer. No, we're not going to give you advice. No, we're not going to give you specific recommendations. And I will note, because we're talking about taxes, that should not be considered tax advice either. And of course, everybody's situation is different. So please consult your tax advisor. But let's give you some insight what to expect during tax season. You're going to see some of these come very soon. These are the T3 slips, of course, right? Where do you get them from? Interesting when you think about an ETF relative to a mutual fund. These, from an ETF perspective, are going to come from respective brokerages. I highlight that because some people are new to ETFs and may not have bought ETFs in the past, maybe have mutual funds in the past. No problem. Just understand this is going to come from your respective brokerage. And we highlighted some of the boxes in here you're going to commonly see filled out as part of your T3. I'm going to mention a few of those as we go through. Now, good news for you too. Let's just jump to the next slide there if you can, Larry. Now, good news, if you're looking for some resources, there is some resources on a public website we helped put together. It's the etfmarketinsights.com website. Take a look under education, and inside there's a great document that highlights what to expect during tax season. In fact, you can probably consider it as a summary of what we're going to talk about today. Let's just jump to the next slide too. Next slide there, Larry, if you can. Now, when we think about ETFs or think about any investments out there, really the primary focus on there should never really be the tax aspect. It should really be about your risk and your objectives for yourself. That's a key thing to think about. Now, if you think about ETFs themselves, two key considerations when you're holding an ETF, when you're buying an ETF, there's going to be a tax treatment based on the distributions paid from the ETF, of course, as well as when you buy or sell the ETF, mostly sell, sorry. When you sell the ETF in the future, there could be a gain or it could be a loss inside. So that's how your taxes are. Let's just jump to the next slide there too, Larry. So with ETF distributions, they're going to happen throughout the calendar year, but the tax treatment will come to you we'll issue it in the end of February and start hitting you through those documentations of the T3 either now or very shortly from now. And I will note, if you have a registered plan, you're not going to get any of that documentation. Don't really need it, really, because it's a different objective for your registered plan altogether. So it's really for those registered plans out there. And one more time, we don't know who holds our ETFs, so you won't get the tax slips from the respective ETF companies. And let's just go to the next slide there, Larry. What are the types of distributions in ETFs? Well, basically, if you think of an ETF holds underlying securities, bonds, equities, international equities. And so whatever we're holding is going to pass through to the underlying investor themselves. So if we're holding Canadian dividends, that's going to pass to you with the ability to have the dividend gross up. I will note, if we're holding US dividends, it doesn't magically become Canadian dividends because it's a Canadian ETF. They still stay as foreign dividends. So you'll get the foreign income there, which is generally taxed similar as normal income out there. In addition, you can get interest income in an ETF. And of course, one more time, you can also get capital gains too through any exchange traded fund. And each one of these is a different tax treatment. Your dividends are grossed up, your foreign income and your interest income treated very similar, and your capital gains, you get the 50%, you can pay 50%. Again, outside the registered plan is when we're talking about this. Oh, just one more step back there for a second, Larry. One thing I get is a couple questions is sometimes you're going to get different treatments of tax between a hedged or an unhedged ETF. It could be the same, for example, S&P 500. And you're going to get a different tax. And we don't understand why that happens. That's generally to do with the capital gains on the currency position itself. So keep that in mind. And we will also talk to you that with capital gains, and I was mentioning return of capital, there will often be adjustments you want to make towards your initial position for those with registered plans. Let's just jump to the next slide, if we can, Larry, because beyond the ETF distributions themselves, you got to think about there's ones that are paid to you, but there's also ones beyond that are phantom distributions. So, of course, one's paid to you, that's pretty straightforward, cash in your hand. We quite often get questions, what's a phantom distribution? That's kind of a nickname, but keep in mind that an ETF provider will have underlying taxes because maybe bought or sold something and it has to distribute the gain. That could actually be pushed to you in a phantom distribution. And really what that's really is giving you is it's giving you the benefit of compounding, because in the asset will stay inside the ETF, but we will pass through the underlying tax distribution, which will push out that tax aspect of a phantom distribution. But again, the benefit is compounding. If you wanted to sell a bit to pay for the taxes, you can do that too, but it's really your choice. Let's just go to the next slide. In addition, what you could get from an ETF provider out there is return of capital too, with inside that. Now, any distribution that's paid out in excess of the taxable income is classified as ROC. That doesn't mean it's always bad out there. And ROC is return of capital, I'm sorry. You could have good ROC too, for that matter. And really, if you think about, if any of you out there have held real estate investment trusts in the past, you may be familiar that they quite often push out return of capital too, generally considered good ROC. You can get that similar aspect within inside an ETF. Because basically the ETF could have some offsets or have some other aspects that they're distributing that return of capital. Now, what do you want to look for there? You want to make sure that the respective ETF company earns underlying income that pays for the yield that you're earning. Because if the yield that you're earning is higher than the underlying income inside the basket of the ETF, that could be bad rock. But if it's earning what it's paying out, that's generally considered good rock, because it doesn't really deplete the capital over time. I will note with BMO ETFs, we focus in sustainable dividends or sustainable distributions in our products.
So Kev, can I ask you a quick question here to clarify? So on an ETF that generates a yield of 4%, all the underlying dividends and income that comes through is 4. So when that ETF is paying out 7 or 8, is that what you're talking about? That's bad return of capital because you're not earning it?
You're not earning it. And that's, the nice thing about ETFs, they tend to be transparent. Thanks for highlighting that, Larry. You can go look at the underlying holdings. You can see what the dividends they're paying. And if it's paying out more than that, yeah, that's generally kind of bad because it's some of your own money back to you, right? Versus an ETF where you have an enhanced approach to it or some structure towards it, it's just generating more yield, that would generally be considered good rock.
So sometimes they're used as marketing to show people a bigger yield so they get them excited, but they're really either getting part of capital gains in terms of the trading of the underlying securities, or they're just getting part of their own money back.
And hand out, let's just jump to the next slide. You could get, with inside cover call ETFs, which is some of our product line is more known for cover calls out there. I want to highlight with inside the cover call structure, generally the option or the premiums that are being written are considered capital gains. Now you can get some times where, we could buy the calls back in the future. Now, keep in mind how the cover calls work, because we generally set a value a bit higher than it is today. And let's say it moves up beyond that position, even though you're up, right? When it moves beyond the position, we buy that option back. That can consider a loss, which could generate return of capital, but that's offset sometimes against the capital gains too. So keep in mind, there's a few moving parts. And going back to Larry's point there, take a look at the underlying, take a look to see if it's actually generating the income to pay for that out there, pay for the premium, pay for the distribution we're paying out. Yeah, thanks. And then the other thing beyond capital, beyond the tax documents you're seeing here, one thing you may want to think about too, if you're a US citizen or you're a person who files US taxes, a lot of Canadian ETF providers now offer what they call PFIC statements. Now, these are reports to just help you fill out your American documentation. And sorry, PFIC, Passive Foreign Investment Company, and it's documentation to help you fill out the taxes for the states. Take a look at that. A lot of ETF providers offer those particular documents. Not always in all ETFs out there. For example, on our website, you can actually see all the ones we offer out there for the additional documentation. A couple more things on taxes quickly for you too. Withholding taxes is something you could get on respective ETF because we hold underlying securities and we got to pay the withholding tax. That does come back as a credit if you hold it outside the registered plan, box 34 in your document. One thing you do want to watch about too, though, of course, is you want to watch to see that if you have a Canadian ETF, make sure it holds the underlying securities directly for international holdings, because that'll avoid potentially a double layer of withholding tax. You can get one layer back outside the registered plans, but you can't do that you can't get back 2 layers. So that's something just to watch for across the board. In addition to that, nice thing about Canadian ETF providers, if you're looking to invest internationally or in the States, there's no T1135s for your documentation. And of course, no exposure to potential US estate tax out there. Now, let's take a look at where you can find information about the taxes ETF providers offer. Most ETF providers put this information on their respective websites, and it could be a good way to figure out, what you should expect in tax season going forward, because you can generally see historical distributions. For example, on our website, you can go and take a look at our distributions, tax distributions tab. It'll bring up this page here, for example. Then you simply select the year you want to review, and then it'll show you at the bottom there the information related to the taxes on that. So it takes the actual distribution being paid, then it shows you the allocation to the respective buckets of taxes across the board there for you. But information generally found on most ETF websites to help you plan a bit forward. It can change from year to year though, just if you know about that. It doesn't always stay the same, but it's a good indication. And the next slide there, Larry. If you're also looking in the tax basis, there are some ETFs out there that are structured to help mitigate taxes out there. In this case, if you take a look, for example, like a discount bond ETF, nothing special here. All we're really doing is not paying out the same level of not buying bonds that have higher coupons. Just makes it more fair tax. In addition, you can look at things like a cover call ETF out there to help mitigate taxes, where you're seeing on this particular sheet, you're seeing return of capital as a bucket, which again, it could be a good rock there, as well as your capital gains there. Take a look at ZWH, you're seeing capital gains. And if you think of ZWH, that's a US high dividend, so you're seeing some of that income that you're being paid to you coming to you as a capital gain. That's that premium we talked about. And then, of course, we did just launch 2 brand new discount bond ETFs in the short term and in the corporate space too. So if you're looking to make your taxation, your fixed income a little more efficient, take a look at those too. And with that, Larry, I'll pass it back to you.
Okay, Kev. Well, there's a question that did come in from an email, and it's related to a tax issue and DRIPs and how those are done. But in this specific case, the person was asking about what happens within RSP plans, and really tax doesn't matter a whole lot within RSP plans. Can you comment on that?
Well, first, let's give everybody a little bit of background. So with the ETFs, if you get a return of capital inside of for an ETF, generally you want to adjust your cost base down because you're deferring income to the future and paying taxes when you finally sell that. If you get, for example, a capital gain distributed to you, because you've now paid taxes on that, you want to adjust your cost base up. Now that's really for outside of the registered plans. Quite often, most firms are now doing this for investors, just to make it easier for their accounting purposes. Now, that also impacts registered plans because they do it at the security level. And then going right back to your point, Larry, yeah, you're right. I mean, while it is adjusting your cost base, it is really not something to really be concerned about here because your focus is on the registered plan and a whole different aspect of taxes because you're going to have your money inside your registered plan for a foreseeable time, maybe rotate through respective ETFs as you hold it in there. And you're thinking more about the money you put in versus the money you take out. And that's a very different process than the annualized taxation that you'd normally go through for outside the registered plan. Hopefully that helps.
Great, thanks. And as a reminder, Kev, you guys host a Market Insights webinar every Friday. You want to talk about that a little bit?
You bet. Thanks for make a note about that. We have every Friday, we run a ETF Market Insights webinar. We've been doing this since the start of COVID, really to help investors understand the aspects of ETFs related towards the current markets. So we invite the audience here to join us every Friday as we talk about different key topics in the overall marketplace, but as they relate towards exchange traded funds. Our topic this week is on international equities, and we'll have the MSCI join us for this session. So hopefully you can join us too every Friday at 1 p.m. And I'll also note that you can go to our etfmarketinsights.com website where you can register there, but you can also find a lot of information and news and resources on that website too. Thanks again, Larry. I'll pass it back to you.
That's great, Kev. Thanks very much. And of course, with COVID hopefully coming to an end soon, I know you're going to continue to do these great educational events. So thanks again for that. Okay, let's dig right in tonight because we got a lot to talk about, a lot to go through. I'm trying something new and different tonight, so hopefully that'll be interesting for everybody. And then we'll have lots of time for questions. So, you know, the geopolitical situation, I'll give a little bit of update on that. And as I commented this week on Berman's call, you know, trading and investing are 2 different things. And, I can tell by the flavor of questions that come in every week, people are focused on the here and now. The questions tend to be around what's moving today as opposed to, what might be a good long-term opportunity for me to think about, although we do get those questions too, for sure. So I want to talk about how I mine for opportunities within ETFs. ETFs are fantastic. I love them. They're the basis of the business I started 15 years ago. But really, sometimes you want to be able to look within the ETFs and maybe pick some individual companies that might be generating some alpha. So I'm going to talk tonight about mining for opportunity and trying to generate alpha from beta, beta being an index, and then the Q&A period. So on the geopolitical front, so this is a chart of the Russian ruble going back to inception. Ruble's been around since 1700, but in terms of international traded markets, it first came on the scene a little bit after the wall fell. And back then, the symbol was RUR for Russian ruble, as you might figure. And it came to trade at $1 US per ruble. And you might have heard Biden or others recently saying that the ruble's trading at 1 cent relative to the US dollar, which means the last trade, generally speaking, if you could trade it, if you could find a bank that would be a counterparty to a trade there, which is very hard to do today in North America, certainly, and in the West specifically, a little over $133. But in the Russian debt default crisis of 97 and 98, the RUR was consolidated back to 1, so 1,000 to 1, and they then called it the ticker RUB for ruble. You can see the currency move there in the 97, 98 period, where we had a massive devaluation. So about a month ago, just prior to the crisis breaking out, I did a session on Berman's call talking about Russia not being investable. There's some great companies that Russia does have that are really have nothing to do with the government. They're well-run companies, but the world we're going into, it may not matter. So when you say is Russia investable, well, currency is a big part of that. And over the last 30 years, you've seen a massive depreciation. And with inflation and everything going to Russia and what's gone on today, I see it getting far, far, far worse for Russia and Russian citizens. And really, it's not something you want to try to speculate in. A lot of the ETFs have been halted. The trade Russia, in fact, all of them have. And will be dismantled and basically valued at worthless, I suspect. So when the stocks start trading again, we'll see. Russia has recently come out and said that they were going to be paying their debts in rubles. Where there were dollars, they're going to be paid in rubles at 1-to-1. And so basically, Russia's in default right now. And there's some links there on the PDF that you'll get if you want to read some more about Russian ruble. But I think far, far worse for the world than thinking about the consequences of when you own a broad emerging market ETF, did it have any Russia exposure in it? Yeah, well, yeah, it did. And that might be interesting comment to hear from MSCI, who's the index creator, on BMO's call tomorrow, to see what they have to say about how they're going to handle taking Russia out of the indexes and so forth. Now, when a company like BP or Shell, which are international, viable UK listed and owned companies, but when they own assets in Russia, like McDonald's does, like Apple does, like all these companies that are lining up to say, hey, we're leaving, there are impacts to earnings and everything else that have yet to really filter into price. all that's coming for sure. But you have to think about this part of the world producing about 20% of the calories in the world. So I did a lot of research this week about who produces what food-wise and what it really means for different parts of the world if those food channels get blocked. Now, it's one thing to say, hey, I don't need to drive my car as much. Maybe I can turn the temperature down a little bit in my home for a little while, but we all need to eat. That's something we can't, you know. So again, a good friend of mine is in the baking business, and he's literally, if he had any hair left, he'd be ripping it out because of trying to secure wheat and sugar and corn and everything that he needs to be a baker. It's to the point where it's catastrophic. So again, I've added a couple of links here. You know, should be very, very interesting. We've seen significant financial crisis over the past couple of decades in Russia. The credit default swap market is very robust, but a lot of these things they're debating right now is Russia in default, and technically if they pay the bond, but if they don't pay it in the right currency and so forth. So a lot more to go here on this file, but the markets are hypersensitive to headlines around, oh, Zelensky's willing to do this, oh, Putin's willing to do that, and then they get together for a meeting and like overnight, nothing done. So, you know, unless there's a willingness for Ukraine to partition and let Russia take what they want, but Russia said all along, we want the whole thing, but maybe they back away from that. So we'll see how it goes, but the markets are going to be very, very, very noisy until all that happens. And obviously, the closer you are to Russia, the closer you are to exports, the closer you are to energy, the closer you are to food supplies and heating supplies. So all these things are going to have implications through international markets. So again, you know, that webinar BMO is doing tomorrow might be very, very interesting to listen to. But the story is really in the very early innings here. And you know, the reality is that the market started correcting well before this was a big issue. The day he rolled in, right, we can highlight it in this big green bar, sell the rumor, buy the news. So in this case, what was the Rothschild's phrase that sell the trumpets, buy the cannons? So the market rallied on, okay, it's done. He's going to finish quickly. And turns out he's not going to finish quickly and get what he wants. So the human toll is up there. And, you know, we'll see how this all plays out. But the common question that we get, and the question there was, is it 133 rubles to the dollar? And the answer is yes. Prior to the war breaking out, it was trading at about 70 or 75 rubles to the dollar. So that gives you, you know, roughly a 60, 70% depreciation in the currency. Back in the days when the Canadian dollar went from parity to 65 cents to the US dollar, you know, not unlike that, really. Not to the same magnitude though. So the idea of relative strength, what is relative strength? So what I've put on this chart here is a year-to-date performance return relative, and everything, every line here is relative to the performance of the S&P 500. So what we have here is the 11 economic sectors. XLE is energy, XLF is financials, XLI, what is it, guys? Industrials. XLY, consumer cyclicals, so the Y in cyclicals. XLB, basic materials. XLP, the P for staples. XLV, healthcare. Don't know where the V came from. XLC is telecom. XLU utilities, XLK is technology, RWR is real estate, RSP is an equal weight S&P 500. So when that ratio is higher than 100, that means it's outperformed by that degree minus 100. So RSP year to date, equal weight S&P, has outperformed the market cap weighted S&P by 3.3754% as of when this chart was created, basically first thing this morning. So there's the updated chart right there. The energy sector is up relative to the S&P 50.5095% year to date. And that's a relative return, not including dividends. Okay, so just relative price return. So relative strength trends tell us what's happening under the surface. And this is something that when I was doing my technical examinations originally back in the 1990s was something that was drilled into me when I did my internship on Wall Street in 1994, studying with the top technical guys in New York. Relative strength was, this is it. You've got to understand what's happening on relative strength because it's what's happening on a relative basis when you're looking at creating outsized returns. Because for a very, very low cost, you can buy a BMO version, a Spider version, an iShare version, and so on and so on and so on of an ETF that gives you a low cost exposure to an index. But if you want to beat that index, you have to overweight or underweight, overweight the sectors that are outperforming and underweight the sectors that are underperforming. And so you have to have a bit of a view on the market. So relative strength, very important concept, and I'm going to show you some charts tonight that look at relative strength as a way to actually mine for ideas. Now, combined with the relative strength are the fundamentals. So I picked a couple of Bloomberg screens here that I use on a daily basis when we're doing our analysis on individual stocks. And I picked a name that everyone would know and is widely covered, Apple. And so when we look at Apple relative to the S&P 500, should we own it or should we not own it? What I want to know that if I'm going to buy something, I want to know that a year from now, the 12-month price target for the stock is not only reasonable from a PE perspective, a multiple perspective, but there's enough consensus around what that number is. When I look at a board like this where you have 48 companies that cover Apple. So this is just one snapshot of it. The date of the last update, the price targets, and so forth. I want to see that there's not a handful of analysts that are saying, okay, I think it's worth 190, 200, but then there's another bunch that think it's worth 160 or 150. And so which group is right? And I like to actually read the research reports if I can get them. Can't get them from everybody. You got to pay for research. It's not free. Generally, you can get some that's available out there for a low cost of zero, but not too much and not in depth. And then you got to look at, what are the projections? What are the earnings? What are the multiples? Are they reasonable? And what are the growth rates and so forth? So all these things to me are an important part of understanding the quality of the earnings expectations. And for me, at a minimum, before I buy a stock, I want at least the potential to make 20% to that 1 year out price target. If it's lower than that, and the analysts think it's worth a lot less, it's just not something that I'm ever going to own because it may just be very overbought, it may be hyped, it may be a bunch of other things where the real fundamental analysts just don't see it as being possible. Doesn't mean it can't happen, but just seems that it's not possible. So I've set up my screen This is one of the charts that I use on a day-to-day basis. And I put Apple in here, and I put it relative to the S&P 500. So the pink line in the middle here is the relative performance of Apple over the last year compared to the S&P 500. And I want to buy a good company like Apple, but I want to buy it when it's at least 20% below its price target. So look at that, where it's trading relative to the red line. So the red line on top is that 12-month forward analyst consensus. I have my standard deviation ranges, which tells me if I'm at the bottom or the top of a trend. Okay, linear regression is what I'm using here. This middle bar is, I'm showing on this chart, but I'm not going to show it on the subsequent charts, are the dollar difference between my price target and my current trade. And so you can see Apple, when this ratio was down in May of last year at around 85 to where it is today at around 107, that is outperformance relative to the index. Where it is today, I don't love Apple. When Apple in December crossed above its forward price targets and crossed above its trend channel, to me is a hard sell, that you just can't own it. It's a great company, but let's wait until it gets better valuation. And so in a registered account, you can trade till your heart's content because you're never going to get taxed on the money until you take it out. In a tax account, you want to think a little bit more like Warren Buffett and not trade around and pay tax every year, but maybe buy a company that you can hold for 2, 3, 4, 5, 10 years and eventually have it double, triple, quadruple, and so forth. So you've got to be a much better fundamental analyst in a cash account, and you've got to be a much better technical analyst in a registered account if you're going to take a more of a trading thing. And why not have a little bit of both so you can do both. So keep that in mind. What I'm going to show you, so I should explain. So the bottom parts of the chart are the relative strength index, RSI. That's the overbought and oversold. Has nothing to do with relative performance, which is what I talked about with the pink line is. So the first one here is the RSI of Apple itself on an absolute basis for Apple. And the bottom one is the relative strength RSI of the pink line. So it's the RSI overbought, oversold of the relative performance of Apple relative to the index. That is a lot to digest, I understand, but you're going to need it for this next segment here. So this week I talked about thematics, a couple of the things that I think are investable for the long term. And I'm going to run you through now my list of ETFs that I have on my should I buy them now list, okay? And so I look for sectors and themes where I think there's a story and a catalyst and valuation. But the challenge with some growth areas is sometimes you go through these things and you price in growth that's, these stocks 5 or 10 years from now might be worth, but you're paying that today. And then what often happens is parabolic up, parabolic down. We're experiencing that today because what drove those stocks higher a year ago was liquidity, cheap money, easy money. And now we're on the other side of that where money's getting tighter, central banks are pulling away, governments can't spend the money, inflation is popping. We've got 2 years or 3 years in front of us a very, very challenging economic combination of prices and a lack of ability to stimulate if the economy turns down. So I'm now going to bring up my charts here, and I've got my chart set up here, which is, again, we're looking at the underlying ETF, and we're looking at relative performance compared to the world index, the world, Vanguard Total World, VT, okay? Up here in the top left corner is the name of the ETF we're looking at. First one we're looking at, cybersecurity. So this is CIBR. It's one of the ETFs that I hold in my growth funds where we're looking for growth. And the question is now the time to buy it? And so you look at it and you say, well, at the low end of the range in January, that was a much better relative buy, where that ratio compared to the world index was at 88. It's now at 98. That move there, even though the stock didn't go up that much, was a 10% relative gain to the world index. So if you're thinking globally, you want to benchmark your performance to the world. It could be the S&P 500 if they're US stocks, but you want to benchmark your performance to the world. And again, overbought, oversold on an absolute basis for the ETF below. I'm going to hit play, and now we're going to run through our list of names. So robotics, Robo. How about this one? This is looking interesting, getting very, very oversold. We'll take a deep dive on this ETF. Next one, Fintech. Here's another one that looks very interesting. I still think there's some growth issues here and fundamental valuation. There's more to go on the downside. Global software, interesting here. But again, some more risk there fundamentally. Israeli technology, iTech. Very, very interesting play. Lots of cybersecurity exposure. The Internet of Things, SNSR. Here's a name too, very oversold, but there's probably some risk in front of this one. There's ARCW, generate next gen internet names. This is Kathy Wood stuff. DTech, again, disruptive technologies. So a lot of same themes here. Some of these ETFs, slightly different exposures. Emerging market internet, EMQQ. So this is the NASDAQ for emerging markets, EMQQ. Looks kind of interesting. ARCG, genomics, again, starting to get to levels that are interesting. That relative strength line down 40%, down 60% relative to the world index. Starting to get interesting. Clean energy. This one was really interesting in January. I added to my exposure there. Medical marijuana. Again, huge underperformer for a year, but look at that spike a year ago. That's why you don't buy into those moves up. You sell into them and you buy into them when they're weak. Small cap US. Here's ARCK. This is Kathy Wood's flagship ETF. Again, underperforming to the tune of 60% year on year. GDX, gold miners, big move up here. I'm selling, I'm looking to lighten up here into the resistance. PIC, global metals and mining, interesting play here. Okay, I'm just trimming the exposure I was buying a couple months ago. ZMT, this is the way I like to play it in Canada. I just cut my exposure in half on the reversal we saw earlier this week at the top end of the range. I'll buy it back on a dip. I still like it long term. Small cap emerging markets starting to get interesting here. Global engineering and construction, if you believe in infrastructure and rebuilding of the world, this could be interesting. Moo, let's talk about the global agribusiness because feeding the world is a big, big thing in the next little while. That one's breaking out. Vanguard semiconductors. Semiconductors, huge part of the future of the world. I'm nibbling now, but there could be some more downside there. Regional banks in the US, maybe some more oversold there. It's at the bottom of the range. Biotech, I think a huge part of the future, along with genomics. That's been underperforming for a year, starting to get very interesting. K-Web, Chinese internet, getting absolutely killed. I added to that position today. Oil and exploration on the gas side. I'm lightening up here. I think we're at the top end of the range. I'll buy it back on a dip. Global infrastructure. These are utility type names. Not a lot going on there. It's overbought relative, but not absolute because it's not gone down where the world has. Global X, conscious companies. So this is, environmental. So the last one was sustainability. Again, another global infrastructure, PAVE. I think this one is very interesting. I own it in my growth and balanced portfolios. I own a little bit. Tolls. Brookfield's Global Infrastructure ETF. Very interesting yield play. Not a lot of growth there, though. Again, semiconductors, somehow that name got in there twice. Climate Leadership ETF. Work from home. Not something I want to own going forward here. Millennials. I think long term could be interesting, but you look through it and it's got a lot of technology in it. New economies. Okay, kind of interesting here. So you look at the ETFs, but you want to start looking under them. Water resources. I think this is huge. Something that's on my radar to add here. I haven't bid on it yet, but it looks good. Auto innovation, so batteries and cars of the future. Tesla is a big part of that. Lithium and battery technology, another thing of the future, but it just got very expensive a few months ago. Uranium. Okay, top end of the range here. I think we lighten up a little bit, but we were buying like crazy below 20. Copper, big part of the world. Again, a few months ago, looked very interesting. I was adding a lot of copper exposure. I'm starting to lighten up right now. Silver miners, love silver. Long term, this is a better way to play it than gold. Silver has a big exposure to the electrification of the world. Fan, global wind. And the last one here, I think, is TAN. Or did we miss TAN? That was the last one. Okay, great. So a lot of long-term thematics there. And so what we're going to do now is look at a couple that I really like now that are kind of interesting. Look at what some of the analysts are saying about some of the key companies. So Fanuc is a major player in Japan in robotics. So it's a big part of the Robo ETF. And JP Morgan just this week put out a comment on it. I clipped some highlights from the research report, which you can see here. And they talk about what's going on there. And they just had a big cut in price. So here's the thing about analysts, okay? And I was on the sell side for a decade, and they don't have to be beholden to anybody. They don't manage a portfolio. They can change their price targets. You're changing a price target from 24,000 down to 16,000, and they go from neutral to underweight. Okay, so they're saying margin pressures are coming to the robotics industry. So that is something that I think you want to keep back here when you're looking at the chart, okay? Because if profit pressures are coming, there could be some more downside here. So with that in mind, let's have a look at our next one. So what we're looking at here is all the stocks, and keep in mind, this is a global ETF, all the stocks within the Robo ETF, not compared to the world index, but compared to the Robo ETF. So the first one we're looking at is Robo relative to Robo, and that's why this relative strength line is straight, okay, because you're comparing 1 to 1. And this is the relative strength of Robo, and at the bottom, we're going to see the relative strength of the relative strength line. But because the relative strength line is flat, you're not seeing anything at the bottom yet. Okay, I'm going to hit play here. Remember, look for the name of what we're looking at up here. And I'll hit play, and I'll comment on some of them. So a lot of these early ones are not going to be tradable. They're going to be Chinese companies. When it's CH by the ticker and it's a number, it's typically an Asian holding. Sometimes there's an ADR that trades in the US that you can track these on. One of the things that I learned when I was doing my internship program in New York from one of the technicians, when Ralph Acampora made his Dow 10,000 call, I asked him how he did it. And he said, well, I looked at all the stocks in the Dow, and I thought, where could these stocks go? Where could I have these price objectives based on the charts? and if I reconstruct them all and they all hit at the same time, what the number would be, and then I discounted at 20. And I came up with a 10,500 target, and I thought, okay, I'll just round it off. And that's how, when the Dow was like 4,000, he came up with a Dow 10,000 target, which is kind of interesting on how he did it. So when you look at an index, so the ETF is an index, and it's an index of all these companies, and you say, where are the individual names? Where are they relative to their price targets? What's the potential here? And then what are the analysts saying about those price targets? And when you put that all together, you get a very, very nice story. So again, here's a sector where the chart relative that we saw relative to the world is at an attractive level. And you say, well, I don't want to buy the ETF, Larry. I want to know what companies I can buy within the ETF. And so this is how you go about doing them. Now, on a sector like this, it is what it is, but robotics are very much a Japanese and a Chinese and an Asian market thing, where the vast majority of the index is in companies that you can't own here. So then for most, the ETF is the way to go. But we'll start to get very soon into some of the US names. And I don't believe there's a Canadian name that's in the ETF. There might be one that is tangentially related to the robotics sector. So you could see a lot of these names here, again, relative to their price targets. They look like there's some pretty decent upside there. A few of these names have ADRs that trade in the US that you could buy direct into those companies, but the vast majority of them don't have those. So here's Fanuc. You can see the price target consensus was 2,700. Remember that one analyst just downgraded it to 16, and it's trading just a little bit above that right now. So you got to wonder if other analysts are going to follow on that, and that's something to pay attention to. But Fanuc is a name that you can actually trade in the US. It has a US ADR that can be traded and bought. And that, again, is one of the biggest. So some of the biggest and best companies can be traded within these ETFs. It's another US name, Aptiv there. That looks interesting right now. ATS Automation. So here's the Canadian name, ATS Tooling. So that's a name that you could buy here in Canada. And then there's some other international names there. Azenta, don't know that company. Guess there was a recent downgrade. You could see. Oh, here's another one, Cadis Design Systems. There's another Canadian name that falls into that index. So you get the idea here of mining and what names, look interesting. So this is a name that we trade. 3D Systems is a name that we trade in our universe. I currently have no position on that right now. Something I'm looking at, but the downgrades outweigh. Deere, interestingly enough, falls into this bucket. Then you wouldn't think Deere's into robotics, but I guess there's a part of the company that's in there. Here's an interesting German play. I believe there's an ADR that you can buy on that one too. Trades in the US. So hopefully, folks, this is really interesting for you guys, and this is what I do all day. I scan through charts, I look for ideas, I do research, I look for names, I look for sectors, I try to get a good sense of what's happening in the world, and so welcome to my chart room from that perspective. So you get the idea here. Let's move on to the next sector. And so I call this finding the alpha within the beta. So there's robotics. Let's have a look at the next sector, which is cybersecurity. Again, something you want to own long-term. I clipped a couple of recent comments. So JP Morgan about a month ago said, like others in the events, so this is a name that I own in the portfolio. Well, I owned it. I just sold it, literally just sold it this week. Lidos highlighted near-term growth headwinds, 2022 sales estimates lower, result. So a month ago, they were talking about this stock, but there was a potential that if they got this Department of Defense contract, that it would add to earnings and really goose the stock. They were lowering their price target at the time the stock was probably in the 90s. They were lowering it to 103, and they gave the rationale, and they expect the 23 earnings number to be 735 and so forth. So you could see if they're going to earn 735 next year, that with a price target of 100, you do the math and you could see the multiple of 14, and 14 is pretty reasonable multiple for a cybersecurity name. A week later, DES wins. They win the DES. So the analyst from Barclays is raising their net present value, $3 a share, blah, 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 talks about all this incremental growth, yada, yada, yada. And therefore, boom. So as this is all happening, let's have a look at some of the names in the cybersecurity space. So again, here's our next one. Again, Cibr Etf. Same thing, relative strength, overbought, oversold, and where it is within the range. Let me get my 1-year lens on here and hit play. So again, international stocks in all these ETFs. Accenture is a company that doesn't have a huge exposure to cybersecurity. Akamai is a name in our portfolio we trade. I just bought some near that recent dip there. So I look for the Cadillacs that were within the ETFs that I want to. Booz Allen is a name that's in our universe. I bought Akamai on that dip, not Booz Allen. Could have bought that. Checkpoint's a name in our list. It's trading above its 1-year target. Not interested at the moment, but those are the meme names that people trade. So they tend to get, stupid at times. Crowdsource is another. Cisco's looking interesting from a relative perspective here. Year on year, about equal to the index. Cibr Arc software there. F5, you'll know that name. That's getting interesting here from a relative price target perspective. Another name not in my universe. Here's a name where there's some M&A activity, I think, going on there. Infosys. You'll know that Indian technology company. Juniper Networks. Again, they're too close to the price targets on these. So, there's just not enough juice left in it for me. Here's Eldos. So the Eldos, I bought it in December and I just sold it out. Mantech International, again, above the price target. Here's another one there's some M&A activity there. Another one above the price target. So within the index, if a lot of them are trading above their price targets, there's probably not a lot of upside. Are there more upgrades or downgrades coming to the stocks and those kind of things? And those things matter to generally get a sense of what's going on in the portfolios and such, and in the sectors. So Palo Alto, big move the other day, pull back here. It's a meme name. It's a Jim Cramer name. You buy it when it makes sense. It's a good company, but don't buy it when it's near its 1-year price target, because probably not going to go much higher. Not certainly, but probably. So I like to buy good companies. I like to buy them at the right places. I like them when they're at the weak end of their trends, and those trends are up, and these are longer term trends that I want to participate in. So know a little bit about the company, know the story, know the catalyst, and try to buy it well and sell it well, especially if you're operating within registered accounts, when the amount of trading has no impact on your after-tax returns. When you're in taxable situations, you want to think about things just a little bit differently, and you want to be able to buy puts and write calls and do other things to protect your assets, so you don't necessarily have to sell them, and you can hold them and be much more tax efficient. Vmware is another name in our universe that I own right now. So Akamai and Vmware are two stocks that are in our global equity portfolio that we run for clients. And there's some Japanese names, Zscaler there. Again, another meme name, getting interesting. I think that's a Kathy Wood name too, that she has in her portfolios. So back to the next sector. So that was cybersecurity. And finally, the third one we're going to look at tonight. Obviously, I could do this all night for all sectors, but we only have a certain amount of time, and this is agriculture. And so, surprising to me, a couple of years ago when I was looking and researching this company, my wife and I went on a riverboat cruise from Budapest to Amsterdam. 2 weeks, highly recommended riverboat, and you stop in a different city every day. And at one point, as we're going through Germany, you go by this massive, lit up at night industrial complex, smoke belching out, and it's Bayer, and a big chemical player, and they're really big in the agricultural space. I was surprised to learn that. So if you look at what's going on there, good fourth quarter results. It's being sold off right now, not because of anything to do with Bayer, but having everything to do with Germany and the proximity to the risk in Ukraine and Russia. So the analyst commented on February 28th, but the crop science business, so that's the piece of Bayer, which is getting close to 50% of their revenue, is particularly positive. So here's a company that you don't think of being an ag company, and you can trade it. It's got a US ADR, and that's the one I own here. So let's have a look at the Moo ETF now and look at some of the names in the Moo ETF. Let's get our 1-year lens up there, which it is, and let's hit play and go through it. So again, international, you're going to have some Asian stocks in there off the beginning because it's sorted by alphanumeric, and so the tickers with the numbers on it actually show up first, one before A in that regard. So you're getting some of them. Again, some of these are available through ADRs. You'd have to find that out if they are, if there's names you can trade in New York. Kubota is one of the names that would have a US ADR. That looks particularly interesting right now. Archer Daniels, you'll know that name, big player, way over the 1-year price target. Stay away. Agco, this is a name I own. I bought it in December. That's a name I own in the portfolio as a way to play the basically there's Bayer is a name I own in the portfolio. It's a way to play the machinery part of farming, right? So there's different aspects. There's the food producers, there's the fertilizers. Bunge, great name, great company. It's at its 1-year target away. You got to wait for a pullback there. Beyond Meat, beyond ridiculous, way overvalued. Wait on it. It'll get interesting in a few years, maybe less. CF Industries. Indonesian there, Indonesian name. So, very interesting sector. Should I buy the ETF right now? I don't own it. I want to buy it on a pullback. Sometimes you just got to be patient and wait. There's a couple names within that sector that I own. Animal health, been really big. My wife's a veterinarian, never been busier. Been a veterinarian for 36 years. She's never been busier in her whole career. IDEX Labs, again, that's another name in our universe. I don't own it at the moment. Again, you see what happens sometimes. These stocks get above their price targets, and when they correct nasty. Here's another one I would avoid, but looked good a few weeks ago. Kuala Lumpur. Leroy Seafood, that looks like an interesting reversal the other day. Here's a hard avoid, Mosaic. So all these fertilizer stocks are ripping higher because Russia is a huge exporter of fertilizer. And pardon me, but we don't want their shit. So a lot of the fertilizer stocks are way up. Now I imagine price targets will move accordingly. Here's Nutrien, potash here in Canada. That's I would avoid them right now, but they're trading off the war theme. As soon as we get some settlement there, those stocks will come back to earth, I think, pretty darn quickly. A lot of you might have the style where, oh, this is a Russian name, right? Boom, zero. So some of these ETFs will have exposure to Russia in them. All right, so you get the idea. So let me get into the Q&A now. We'll take the questions that have come in, and then I'll get to as many of the online ones as possible. Can I recommend a Cibr ETF that you use in the investment strategy? So SIL for the miners, SILJ, I think it is, for the juniors, and SLV for the bullion are the ones that I use. I don't play the juniors, though. Democrats are set to lose. I've talked about for a couple of years now, ZMT is a way to play infrastructure. So infrastructure is beyond, it's greening, it's technology, it's supply chain, ZMT. But again, I recently cut my position in half on ZMT. I still like it, but I trade everything, right? It's never buy and hold, it's buy and be tactical. So right now, a little bit overbought. If it keeps going up, I'll sell the other half of the other half, and then eventually, if it gets silly, I'll be out. Sizing is very important when you think about those things. Am I still in HMMJ? Yes, it's been very depressing trade. I do understand that they are trying to pass banking legislation. There may be a couple of bills related to sanctions against Russia that legislation may get put into. We'll have to see, but we are getting close. But the Republicans want that too, and there's tax money there, and I think ultimately something does get done there. And I would just keep a small position there. Keep it at whatever 1%, 2%, 3% of your portfolio. If it gets smaller, keep adding, keep adding, keep adding. Someday soon, that's going to be a home run. In the media, there have been a lot of comparisons between Joe Biden and Jimmy Carter from an economic perspective. Can I explain the similarities? Well, I believe they both like jelly beans and peanuts, but they're both presidents who had to govern in a high inflation period, and because of that, lasted one term. So that's probably what they're talking about. In a difficult economic environment, people have a bad time and they blame the president and they vote for change. So, that could be it. I suspect Biden is not going to run again. Obviously, he's never going to say that until it's, because of lame duck issues. Kamala Harris has proven to be a very nice woman, and beyond that, she is not presidential material in my humble opinion. I don't know who's going to run the next time around against whoever the Republican candidate, but I got to tell you, I don't like any of the choices from either of the parties. I don't know if that answered your question, but thanks for that one. Why have tech stocks been taking such a beating over the last couple months in particular? Tech stocks are long duration assets. A lot of tech stocks, not Apple and Microsoft, but the up and comers, the next wave of technology. A lot of them don't make any money yet. They have massive multiples or no multiples because there's no positive earnings. And so when you go through a difficult economic period and you go risk off, the money flies because financial conditions are tightening. Money comes out of the speculation first. And ultimately, if the economy turned bad, it comes out of the good names too, like the Apples and Microsofts, and everything gets sold. The good quality, high quality names are typically the last to go. So what we've seen over the last, not only the last 2 months, but the last year, is a lot of high flying meme stocks that ramped up because money was free and the government was putting cash in everybody's bank account. Now is no longer the case and won't come back. And that's why the liquidity is drying up. What are the economic impacts here in Canada as a result of war in Ukraine? You know, inflation is the biggest concern, I think. The Canadian dollar has stayed relatively stable. In theory, it should be a lot higher given where energy prices are. But it would appear that the vote from international investors is that Canada is not investable under the regime of the current administration, where they have no respect for energy or anything like it. I think people may start blaming Trudeau, but we'll see. You know, rising oil prices are not his fault. He is a big supporter of the environment, absolutely, as we all should be. But you know, the underinvestment. Hey, listen, you know, the 3% of oil that Russia sends to the U.S. every year could very easily have been in Keystone XL by now. Just saying. So you know, it's really you know, a big impact in that regard. Canada's terms of trade, because of rising oil prices, which in part is because of what's happening in that part of the world, has been a boon to Canada's terms of trade. So we're running surpluses now on both on the capital and current account. Again, the Canadian dollar should be a lot stronger were it not for the risk-off sentiment in the world today that usually favors the US dollar. So those are some of the factors to think about there. What's the best ETF to access clean energy and nuclear? Clean energy and nuclear are different things. In the clean energy ETFs, there are no uranium and nuclear plays. The EU just passed some rules where nuclear is part of clean energy. It wasn't considered. I don't know if the index providers would roll that in. Maybe they will, maybe they won't. ICLN has been the longest standing clean energy global ETF play out there. And BMO's version, ZCLN here in Canada, is basically the same index and would be something that either one of those two are the ones that I will use in the funds that I manage. As we move away from all COVID mandates and the world opens up, can we expect to see price decrease from big pharma and medical companies? So I'm not sure if you're asking about, are their cost of drugs going to decrease or are their stocks going to decrease? And here's where I think biotech is the future, helping us live longer. XBI is one of the ETFs for the biotechs, but there were a handful of names in there that got very, very big. Moderna is one of those, and it swings around a lot and has a big influence on the ETFs. And a lot of those names, once we get through COVID, are going to, say, come back to earth, so to speak. And we're starting to see that already. So if that's kind of what you're referring to, then it's more of a company-specific thing than it is a sector thing. And that if the big biotechs don't have a lot of exposure, then they're not going to be impacted very much. Is there a difference in the high dividend ETFs over ESG ETFs for returns? Looking at ZWC, a covered call Canada ETF investing in high dividend paying companies, where XEI is not a covered call ETF investing in the same type of companies. Which is better to invest in if I'm looking for more stable growth and yield returns? So high dividend and ESG, not really related. There's generally, some overlap in the names, but really, Microsoft and Apple are highly ranked ESG companies, but are also high dividend, or they're not high dividend payers. But within technology, they are, because big tech doesn't pay big dividends, right? If you look at the NASDAQ, it pays less than 1%. So if a big tech company is paying 1.5%, that is a high dividend technology play. IBM and a few others, some of the mature semiconductor stocks, for example, Cisco would be one of them, and Intel would be high dividend tech names. So those names tend to screen well for ESG. ZWT is a ETF that plays big tech with a covered call. So that might be something. Which one's better? There's none better than the other. It's have a bit of everything in your portfolio. Too many times people say, should I buy this or this? And the answer is, I like both of those things. Which one today is better to look at? And that's where you bring out your relative strength charts and you start to do that. Analysis. How do you think copper and base metal stocks will perform if we get stagflation? So that's a great question. So stagflation is high inflation and stagnating growth. And the type of inflation we're getting today is cost push supply chain issues and not demand. If it was demand led, then the base metals should continue to rip. If the supply shortages get fixed, prices come down, those stocks don't do well. And that's the kind of inflation we have today. So right now they're doing well, but they're not doing well because we have inflation. They're doing well because of supply pressures, and they're doing well because there's a lot of speculation as a hedge in some of those real assets. So all those factors at play, once the supply chain issues have a visible end, the war's over, COVID's over, people are going back to work, companies say we're not seeing that anymore, that's when these things are going to underperform significantly, and I don't want to be in my copper names and ZMT names until they correct again to levels that are more reasonable, bottom of the channel, and then we buy them back. ZWE is now paying close to 7%. ZWE is high dividend paying Europe, covered call with a hedge. Would I buy it, or is it premature? I don't know when the war is going to end. I don't think anybody has any clear visibility. I added to my exposure in Europe this week. Canada was performing very well because of the energy component and our banks' safety relative to the European banks. I think a lot of that is priced in. The European banks fell 20, 25, 30% in a couple of weeks because of the uncertainty around debt that they might own from Russia and so forth. And I think that's in the market. And I sold my exposure to the TSX and I bought into Europe. I think there's better value there. I don't like the makeup of the TSX, and I don't think the move in energy is sustainable beyond some visible period. I know a lot of people are saying oil prices are going to stay high, and I just think we're very, very close to peak demand for oil, way closer than the oil bulls will tell you. So again, what analysts do you believe? So we have 10 more minutes for questions here. Let me take some of the live ones. before I go out to think. So some of the early questions that have come in. Sanctions against Russia have a ZWE influence. So I think I just answered that question. Gold has finally come back. Since August 2020, we've retested the highs. Many of you will know this week that gold spiked up to the highs we saw in 2020. Where do you think gold will go, and how will it act as a hedge against inflation? It's been the trade that I've been most right about and most wrong about in my life. The value is there, the story is there. Gold just won't go here. It's running now because of the flight to safety. And again, as soon as the situation in Russia, Ukraine stabilizes, gold's going to come back to earth again. Inflation pressures will moderate, oil prices will come off the boil. And, you know, so I'm selling into it here. Fundamentally, these stocks should be way higher, but it's just not working. I've moved my exposure to silver because I think there's a better long-term story in silver from the demand side, not only from the precious metals hedge, but from the fundamental demand of electrifying the world and silver's role in that relative to gold. So that's a great question. I don't think Putin cares if he's in default. No, I agree with you, JD. I don't think he cares. Why does the US not backfill the offer from Poland to give 28 MiG fighters? So it's about escalation. And I think the confidence around mutually assured destruction, which is Russia and the West is well armed in nukes, and we have more than enough nukes pointed at each other to annihilate the world. And nobody wants that. I don't believe that Putin has the ultimate trigger. I do believe that it takes not a village, but a small consortium of opinion to go to that. And I don't think he's suicidal. All the geopolitical guys that I've listened to in the last weeks don't believe that. But they didn't believe he was going to do what he did. So, you know, there's an element of uncertainty there that I don't think NATO wants to step it up. Now, if Putin is really stupid here and crosses the border into Poland, first of all, he doesn't have the army to do it. So NATO countries aren't at risk. Ukraine is not, the humanitarian issue is catastrophic. It was catastrophic in Syria, it was catastrophic in Iraq, it was catastrophic in Iran for the common folk that aren't radicalized and politically motivated, and it's just a tragedy what's happening to Uyghurs in China, and I can go on and on of all the human tragedies in the world in so many different places. And one of the offensive things, if you read deep into the Twitter sphere, and I think I'm going to stop doing this because it makes me sick. If you read the opinions of people from other places in the world that aren't the West, the view of America butting their nose in everywhere in the world is pretty interesting. And there's widespread differing views on the reasons for Putin doing what he's doing. And a lot of it was that when Russia was weak and the wall came down, the US took their knee and put it across Russia's neck and broke apart the republics. And, you know, he wants Mother Russia back in the USSR, and he wants that buffer between the West and that. As long as Putin's in power, then Russia is going to be in the penalty box in a big way. And you know, all that Russia supplies the world is going to be in question for a long period of time, unless they give Putin an off-ramp. They give Putin a way that he can declare victory to his people. Ukraine can stay Ukraine, and he can get what he wants for now. Maybe he tries it again in the future. But if they put in their military there and they do anything other than being defensive, that it notches it up, right? And that, to me, could be is something that when you play war game scenarios, you just don't do that. From a humanitarian perspective, if you take that lens, you say, yeah, why didn't he do that? He should have been doing that. But they don't want to step it up. If Putin decides to peg the ruble against gold, yeah, they don't have enough gold to do that relative to the rubles that they will need. I doubt that that's possible. Question here, let's see. If Apple doesn't bounce here at 150, is it heading sub 100 in short order? No, I don't think we'd see it do that. Subsector on uranium, URA is up 13% on the week. Yep, it's been a good one. Is Cibr still a short? I don't think Cibr. It was a short months ago. No, You want to own cybersecurity. See, if you're talking about CYBR, the company, it's not a name I would buy right now. Kathy's still been taken out to the woodshed along with Kramer. You know, when you get into these markets that are pump and circumstance, people look great for a while, but you got to understand the cycle. There's always a cycle. There's ever and always going to be a cycle. And, you know, as someone who's studied those, I understand it. And I'm not a buy high and sell high, you know, guy. And why is ZZD so volatile lately? Well, thank you for that question. That's a good one. And so I've put a lot of exposure into international markets and emerging markets in the portfolio. It's pretty close to half into international markets, and those markets have been hurt hard. And when I put a hedge on the portfolio for volatility, I'm using the US market to do that. So it's temporary. Not much I can do about it. So a little bit more volatile than I'd like to see it for sure. But I think all those come back in due course as we get through this uncertainty. And I'm actually adding exposure to that part of the world because that's where the value is. And so we will go through these periods. I try to dampen the volatility as much as possible. And so, William, thank you for the question. Yeah, it's pretty close to the one-year lows at this point. But that's the reason why. Fertilizer is very expensive now. Yes, it is. How are we doing on time? We got 2 minutes left. I got time for a couple of more questions here. I can't see the symbols, so sorry about that. Is Fanuc the ticker? So FNUY, Fanuc is the name of the company. FNUY, I believe, is the ADR for Fanuc. But if you do a search on whatever platform it is that you're trading on, Lawrence, I think you'll come up with it. Good chance this week we've seen the lows in equities for a little while. We've probably made a bottom. We very likely haven't made the bottom because what this is, we're in the very early stages of the Fed taking the punch bowl away and fighting inflation. That has 2 years still to run, right? That hasn't even started. Next week we get the first Fed rate hike. So, you know, keep that in mind when you're thinking about markets here. Tradable bottom, we bounced, but we're not making new highs anytime soon. In fact, not a forecast, but something I'm thinking about. I don't think we see S&P 5,000 maybe till 2024 at this point. And we most certainly have a dip below S&P 4,000, you know, before then. somewhere around 35, 3,600, I think it would be a bargain, as long as we don't go into a strong depression, or not depression, recession, caused by a Fed tightening too much if inflation runs away here. But I think inflation will start to cool. The Fed won't have to raise rates as much as they think, but inflation will be sticky and bonds remain a terrible investment. Folks, thanks for being with us this week. We're out of time. Please consider going to one of the websites, getting involved with one of our sponsors and partner companies. And please, if you enjoy the learning here, make a donation to one of the links we send out with the ETF email and the copy of this presentation, and we'll be thrilled to match them. Stay safe, everyone. Have a great week.